I'm Diane Rosignola with NAREIT. In conjunction with NAREIT's REIT Week, I'm here today with Sumit Roy, President and CEO of Realty Income Corporation. How is Realty Income positioned in light of the pandemic?
So, at the beginning of the year in February, Realty Income issued $760 million of equity at near all-time high equity prices. At the end of the first quarter, we were at 5 times debt to EBITDA in terms of leverage. We were at 5.5 times interest rate coverage, which was a record high for Realty Income. We are sitting on $2.9 billion of liquidity, of which $1.2 billion is cash. That's on our balance sheet. So from a balance sheet perspective, I don't think we could be entering this pandemic-induced downturn any stronger. The fact that we were able to further, pay down our line by issuing 10-year unsecured debt just last week, we did $600 million, further strengthened our liquidity position. From performance-wise, with respect to rent collections, et cetera, the month of April went better than what we were expecting. We were at 83% rent collection. May seems to be trending in a similar fashion where it's better than what we were anticipating. There seems to be some level of normalcy in the cadence of the business. And so we feel very good in terms of, the states that are opening, some of the businesses are starting to do better on a week-over-week basis. And, our balance sheet is strong. The operators that we are working with, our clients, they're doing better with every week that goes by. So as long as we don't run into a situation where the level of contractions increase, the infection rate starts to increase, as long as that situation doesn't play out and these businesses are allowed to open as anticipated today, I think we'll be just fine.
How are you thinking about playing offense as the economy recovers?
Yeah, for us, part of the answer to my first question has positioned us very well. We stress tested our models based on fairly draconian downside scenarios. And what we wanted to be able to tell our board and our investors was that we will no longer be relying on the capital markets, given the volatility associated with the capital markets, for the foreseeable future, based on what we know today, based on how we're seeing things recover. And that's a very powerful thing to be able to say. The fact that we have $1.2 billion in cash also allows us to have the dry powder required to play offense as soon as there is some level of clarity in terms of this recovery really taking hold, businesses really taking off, and product returning back to the market. In large part, most of the net lease companies have at least, if not pulled back completely, have slowed their frequency with regards to organic acquisitions. And part of it is driven by the market. There's a pause. Sellers are still expecting pre-crisis level cap rates, and clearly the markets have moved, and so there needs to be some time for the cap rates to adjust. But I will say that the higher quality product, the essential retail side of the business, it continues to be very healthy, and the cap rates there haven't moved. And what we wanted to be able to do was position ourselves in a way where as soon as there is light at the end of the tunnel, we'll be first in line to be able to play offense. And so we've become much more selective than under normal circumstances. But we are still in contact with our, relationships on the brokerage side, on the client side. We're still engaged in conversations on how we could be a capital provider. And all we are waiting for is some level of clarity in terms of the recovery to be able to play offense.
How will the pandemic change the use of real estate in your sector?
Yeah, that's a very interesting question. I do think, there are some real winners coming out of this pandemic, and the corollary is also true. If you think about the essential retail side of the equation, which is almost half of our retail exposure, folks like grocers, dollar stores, drugstores, convenience stores, those businesses have continued to do very well and have actually had a tailwind through coming from this pandemic-induced downturn. The businesses that have suffered are on the theater side, the health and fitness side of the equation, to some extent on the casual dining side. I do want to make that distinction, and daycare centers. And so that particular part of the business, I do think will go through a rationalization process, especially operators that don't have the financial wherewithal to be able to come out of this or withstand the duration of this downturn. They're going to permanently close, it is going to create an opportunity for the stronger operators to potentially consolidate and or just have fewer retailers. And on the positive side, I do think those businesses have learned that having an omni-line presence is incredibly useful. We've seen companies like Target say that their online sales increased by 1,000%. Walmart and Kroger have come out with similarly healthy numbers in terms of online click and pick up. I do think that micro distribution adjacent to existing footprints could potentially be a store of the future. And potentially even the front end part of the sale contracting a bit and the back end becoming more conducive for click and pick up, because that's part of the business that really did take off. And now, as to whether these habits are a permanent shift in consumer behavior, time will tell, but it will certainly be a shift. And we do see that will become a bigger part of the retail space going forward. And so there will be demand for additional space to accommodate some of the omni-channel strategies that have really taken effect through this downturn.
Sumit, thank you so much for your time today.
Thank you very much, Diane, for having me. And as always, stay safe.
For more from REIT Week, visit REIT.com.